The Federal Reserve has backtracked on the amount of interest rate hikes that they've been discussing or potentially could occur over the year. And as a result, most investors have flocked to risk assets in the first part of this year. This has caused risk premias to actually become quite expensive again. So credit risk premia has moved quite significantly expensive. And in addition to that, interest rate risk premia has become very expensive. The problem with this is that for the interest rate risk premium to stay as expensive as it is, you need to expect a recession of some degree. And if we have a recession, this will be very difficult for corporate bonds and other credit instruments. And those are quite expensive as well. So you have to make a choice as to which you think is more likely. Do you think the economy will be strong and credit will do well? Or do you think that the economy will do poorly and interest rates will do well? The margin for error that the markets are giving you right now in terms of valuations is not very high. So this is very difficult for investors, and thus an element of caution is warranted right now. As Q4 unfolded, we saw risk assets sell off, credit spreads widened. During that period, we drew down that cash and became more invested in risk assets. Now, as 2019 has started, we've seen a very strong rally in risk assets as the Fed has eased off on its hiking language. So as this rally has occurred, we have actually benefited from it because we were further invested. But while we have increased our cash position, we do believe there is potentially room for credit assets to continue to perform well. However, the margin for error is much smaller than we've had before, and therefore it's prudent to raise cash in case there is volatility in the markets. We believe the potential for volatility still remains within the market. Therefore, option strategies that benefit from rising volatility are particularly attractive in a portfolio, especially since they have excellent portfolio construction properties with the rest of the assets in your portfolio. Additionally, we believe that opportunities within the mortgage market in the United States are particularly attractive. Commercial mortgage-backed securities, or more specifically, derivatives on commercial mortgage-backed securities called CMBX, are attractive right now. There are many investors in the US right now who are worried about the prospects for the retailing industry. This includes worries about commercial malls. These investors tend to short the commercial mortgage-backed security derivative in order to express these views. However, because of the preponderance of shorts in the market, there is significant amounts of value in these securities now, and we believe this is worth harvesting. There are a significant amount of events that could occur this year that could have a negative impact on risk assets. In particular, we have a global trade war which is unresolved. We have events such as Brexit. We have the fact that risk premiums are actually particularly expensive right now and priced to perfection. There are a lot of things that could have occurred. The one theme that I believe that will be prevalent through this year will be increased volatility. So having strategies that know how to profit from volatility is exceptionally important in this market. It is no longer sufficient, as many strategies have done previously, to hold yield, to harvest it and generate returns that way. One must be prepared for the volatility that will occur and must have strategies that can profit from this.